Hello from wherever you're watching from. I would like to officially welcome you to our YouTube channel, and basically the channel will be all about the financial markets, forex, stocks, indices, and just sharing some of the insights that I've had a chance to learn from, especially ICT, Michael J. Huddleston, and in no way do I claim authorship of some of the concepts that I shall share in the subsequent times, or rather sessions that will interact. They are not my concepts. I don't claim authorship of them. I've learned them in Michael J. Huddleston's YouTube channel, and I just felt like sharing some of them, if not all, and I hope we'll all get to enjoy. Welcome on board. Now let's dive into our euro dollar chart, and basically we'll just try and backtest and see some of this, see how these concepts come into play. Now commencing with the euro dollar chart, I think it's fair enough if we hop straight into the higher time frame, and we'll start with the 3-month. And for some, maybe this is quite a high time frame, very high, but let's see how it goes. Now from a 3-month perspective, this is our euro dollar. And first, to begin with, what ICT normally emphasizes, especially for the neophyte traders, or rather the ones that are getting into the industry, and mind you, I'm still new in the industry, and I'm not seasoned as far as the financial markets are concerned. I'm also a neophyte trader, but as best as my recollections serve me, ICT normally emphasizes the fact that price always move because of two primary reasons. And number one is to fill up an inefficiency, and an inefficiency can exist in the form of a fair value gap, a volume imbalance, and a liquidity void. That's the first reason why price moves. And the second is to take out the sell stops and buy stops, to take out liquidity in the form of sell stops and buy stops. And normally sell stops are always positioned, or rather are bound to be on previous lows, old lows, and buy stops, old highs. So for instance, right here before us we have a 3-month chart time frame, and I believe we all know that presented with a 3-month chart, each and every candlestick represents a time frame of 3 months. And let's just try and look at the swing points where price has reacted, or rather reversed. And number one swing point, we have this here. We have this point here. If we look straight into our left, we have something here. This is a fair value gap. This is our fair value gap. And our fair value gap is in the form of a BC. BC meaning buy side inefficiency, sell side imbalance. The meaning that price was delivered, let me zoom it a bit. Price was delivered on the buy side, and it lacked sell side inefficiency, buy side imbalance, sell side inefficiency. It was delivered only on the buy side, and as such it lacked sell side delivery, forming this BC. Now casting forward in time, our fair value gap, and this, mind you, this fair value gap formed on was created on Monday 1st April 2002, and if we extend our fair value back in time to the current market price, we see it formed like a sort of a reaction point, meaning that this is where price reacted from. Look at how it hit it, it dug slightly into it and repriced away almost immediately. Now that is very powerful, meaning that this was the algorithm treated this point here as an imbalance, and thus it needed to be filled. And fair value gap doesn't have to be filled immediately, doesn't have to be fully filled, sorry, but just a slight reaction is quite permissible, as ICT emphasizes, or rather says like this. This is quite permissible price action reaction, and that's our first reaction point. And if we also look at here, these 2 points onto our left, immediately onto our very left, see we have something here, fair value gap, right? Let's annotate it. This, friends, is our fair value gap. And when was it formed? The fair value gap was formed on Wednesday, 1st October 2014. And always, there's one thing I forgot to mention. I know some of you are wondering why I have 3 lines. This broken line, this rectangle, in this rectangle I have a broken line, or rather dashed line, and this dashed line represents simply the halfway point of this rectangle. Now ICT always emphasizes that the price always is born to react on the midway point of a fair value gap, and we call the midpoint of a fair value gap consequent encroachment. It's a very sensitive price reaction point. And just to emphasize that fact, or rather to prove, not to prove per se, but to just open your eyes to something, look at this. Look at how price nicely reacted onto the halfway. Look at how the bodies of these 2 candlesticks were slightly below the halfway point. And look at how this candle reacted nicely on Friday, 1st January 2021. Look at how it reacted at halfway point of that fair value gap in the form of a CB, sell side imbalance. Let's annotate it. CB. This is our price was delivered on the sell side and it lacked the buy side, and this is our buy side. It came and sort of almost filled the fair value gap, but you see reacted away almost immediately, and this midpoint formed the very sensitive reaction point. And this is not a coincidence, friends. It's not a coincidence. And yeah, that's our BC and our CB, and mind you, this is our 3-month candle chart, sorry. And if we look closely, when after price reacted in this BC and repriced away immediately, you see it left this last down close candle before this move from this bullish candle. And friends, this down close candle forms our ICT bullish order block. This is our bullish order block. And an order block, as Mr. Michael J. Huddleston puts it, an order block has nothing to do with orders resting there or something more of that sort. An order block is simply a change in price delivery. Price was delivered on the sell side, and now price is about to be delivered on the buy side. So it simply, an order block is simply a change in the state of delivery of price, and that's what happened here. You see price, let's zoom in a bit. You see, after price reacting upon this BC and reprices away, you see our bullish order block is formed, and this very next candle, or this on Monday 2nd January 2023, you see price repriced almost immediately. It repriced, it dug slightly deep into, just slightly into our bullish order block and repriced away. And price again came at this point in time on July 3rd, 2023, and revisited our bullish order block. And on to the next quarter, that is on October 2023, it came back, not came back per se, but the delivery went slightly into it and repriced away. And now this is the current market price as far as the 3-month candlestick chart is concerned. And if we scrutinize here, where this reaction, if we look onto our left, there is something here. This week, we have a week, and what ICT says is that whenever there is a week, whenever price forms a week, or rather candlestick forms a week, midpoint of that week is always a very reactive, or rather sensitive price point. For instance, if we pull out our fib and measure this week, or rather tail, and let's measure the 50%, which forms our consequent encroachment. Yep. Let's use this. That's our consequent encroachment. Let's get rid of the fib. Now look at what happened. Although it slightly fell short of that consequent encroachment of this candlestick here, and right below this candlestick, that is the low of this candlestick and the high of this candlestick, we have our fair value gap. This is our fair value gap in the form of a CB. CB meaning sell side imbalance, buy side inefficiency. Price was delivered in the sell side, and as such it lacked the buy side delivery. So that's what happened here. You see price blasted past our CB and repriced lower, and during this next quarter, you see it repriced into the consequent encroachment of our CB and went lower on the next quarter that we are currently in, and we are about to probably move into the second quarter of the year 2024. This is where we currently are. And if we scale into 1 month time frame, let's see what we have. Now onto our 1 month time frame. Down here, or before we get there, we have something here, over here. This candle's high and this candle's low forms See this candle's high, this candle's low. Now this is our BC, buy side imbalance, sell side. This is our buy side imbalance, sell side inefficiency that was later filled by this candle during last month on February. And right down here we have a low, and what do we have below all lows? And for this to first of all qualify as a low, for this to qualify as a low, we have to look at this 1, 2, 3. We have one candle here, and to the left of this we have a candlestick that has that is slightly higher than this candlestick that we are referring to, and to the right of it we also have a candlestick with a higher low of this. So this forms a long-term swing low. It's a long-term swing low because of this. You see, to the left and to the right of this we have candlesticks with higher lows, both to the right and to the left. So it acts as our long-term low. And what do we have below all lows? Below all lows we have something resting below such all lows. We have sell side, sell side liquidity. This is our sell side liquidity. That's our sell side liquidity. And slightly below our sell side liquidity we have something over here. Slightly below our sell side liquidity we have this. This is our BC, buy side imbalance, sell side inefficiency. Price was delivered in the buy side, and as such it lacked a sell side delivery. So there is need for the algorithm probably in the near future to want to reprice into our BC. So what else do we have? That's our BC. And remember, this is our also BC from the 3-month perspective where price reacted from. And this is our CB from equally the 3-month perspective. And if we look here where we had our 3-month consequent encroachment, this is what I mean. This is our 3-month, and this the consequent encroachment, meaning the midpoint of this week over here, this week. If we scale into our 1-month time frame, you see what do we have here? This is our bearish order block. And you see we have a wick in our bearish order block. So if we measure, remember, halfway point of wicks is a very sensitive price reaction point. Look at this. It coincides with our 3-month, is it the discount? 3-month premium, 3-month premium consequent encroachment. You see, here is the 50% of this bullish order block, which coincides, or rather is nested within our 3-month premium wick consequent encroachment. let's move on to our weekly. Let's scale into our weekly euro dollar. Now onto our weekly, we had this. This is our volume imbalance. It acted as a draw on liquidity. And if you've probably watched ICT's mentorship as far as 2023 is concerned, then you'll be familiar with this, because he clearly highlighted this. He called out for this volume imbalance, and it happened just as he had said. Yes, that's our volume imbalance. Let's annotate it. My chart is a little bit messy, but you'll have to bear with me. That's our volume imbalance. Now from the higher time perspective, we've looked at the 3-month, and you see this is a PD array that we had on the 3-month, and this is our weekly, the PD array in our weekly, and these other ones are from the monthly time frame. So from our weekly, this, see this, we had buy stops resting over here. See here, these are buy stops that were these are our buy stops. See, they were taken out, and later we had a shift in market structure here when this swing low, when this swing low was taken out, we had a shift in market structure. And probably if we dive deep into here, this fair value gap over here, this candle's low and this candle's high, it forms a fair value gap in the form of a CB, sell side imbalance and buy side inefficiency. It lacked delivery on the buy side. Price was delivered on the buy side, and it was inefficient. Sorry, it was delivered in the sell side and inefficient in the buy side. So you see this, when we have a fair value gap, and the very next candle slightly digs deep into this fair value gap, this gap that we have here, without necessarily getting into halfway point, which is our consequent encroachment. So this is that's our fair value gap. That's the low of that candle and the high of this candle, forming our fair value gap. Are we on the right track? That's the low. And that's the high. Now halfway. Halfway, 50% of this. This is the 50%. Let's get rid of the fib. Now this 50%, this is our consequent encroachment, and when a fair value gap has been formed, just like in our scenario here, this is a fair value gap. This high, the low of this candle, and the high of the very high of this candle, and that forms our fair value gap, and this is the midway point of this gap, this here, that's our consequent encroachment. Now when a fair value gap has been formed and price reprices immediately after the next candlestick reprices immediately into it and shows a willingness to want to reprise away from it almost immediately without necessarily getting into the midpoint of this fair value gap, this here, this consequent encroachment, we call that an institutional order flow entry drill. Now this, friends, is our institution order flow entry drill. That's our institution order flow entry drill, which is a partial entry into a fair value gap without necessarily getting into its consequent encroachment. Now that's from a weekly perspective, and over here we have this is a swing low. Remember how we've defined our swing low. If you look at this candle, right to the very left of it we have a candle with a higher low, and to the right of it equally we have a candle with a higher low. So it qualifies, this qualifies as our low. And friends, what do we have below all lows? It's an whole low. What do we have below all lows? We have our sell stop, sell side. We have sell stops below our all low. So this forms our sell side. This forms our sell side liquidity. Okay, that forms our sell side liquidity. So probably that might be our next draw on liquidity, and probably if price, we also have something over here. Look at this. Look at this. Let me get rid of that. Look at this. This is our fair value gap in the form of a BC, buy side imbalance, sell side inefficiency, and let's measure halfway point of it. That's our consequent encroachment. Halfway point. Is our consequent encroachment. That's our fair value gap's consequent encroachment. Halfway point. Now friends, this is a classic example of institution order flow entry drill. This is our institution order flow entry drill. Institution order flow entry drill. That's our institution order flow entry drill, which we've said that it's a partial entry into a fair value gap without necessarily getting into halfway point, our consequent encroachment. So this is our sell side from the monthly perspective, and this is our sell side in the weekly, and let's hop into our daily time frame. The chart is a bit messy, but have to bear with me. It's a bit messy. This is our daily time frame. See, from our daily, we had sell stops over here that have been purged. Sell side liquidity. That's our sell side liquidity from the daily that was taken out today. And this is the next price obstacle. Look at this. These two down close candles. These two down close candles. Let's annotate them. The two down close candles forms our bullish order block. They form our bullish order block, the two down close candles. So that's the next price. That's a price obstacle. And when a candle closes way past the mean threshold of these two, this is what I mean. Mean threshold is halfway point of an order block. If we take our fib, measure from this candle's opening price to this candle's opening price. For us to probably maintain a bullish stance, then the price must not close way below this halfway point of this our bullish order block. It must not close below the halfway point, which is our mean threshold. And if at all it closes below the halfway point of this order block, this is 50%, the mean threshold. This, if it closes below it, then our next drawn liquidity will be here, the sell side, these old lows that we have here, where we have a bunch of sell stops resting over here. That will form our next draw on liquidity. That is if and if only the candlestick closes way past the midpoint of these two order blocks. And you see the reaction that we have from this. It has tapped into it slightly, it has dug slightly into it, and it has shown a willingness to immediately reprice away from it. Now that's a very powerful price signature, and as ICT puts it, that's a unicorn. It's a unicorn, very powerful price signature. And here, look at what we have here. What do we have here, friends? Look at this. This is a volume imbalance. Remember, from our weekly, we equally had a volume imbalance. Remember this, friends? remember this volume imbalance. Look at what happened. It acted as a very sensitive price reaction point, and price reversed the very moment it hit slightly out of it. Okay, and this very same price signature, this is what we have here on the daily. This, it's very powerful. The volume imbalance, it's very powerful. This is what we have here. And a volume imbalance is when we have no bodies, actual bodies between candles, like this, from this candle's closing price to this candle's closing price. We have no bodies marrying each other, or rather bodies passing through it. So it forms a volume imbalance, and price treats that as per ICT as a drawn liquidity. And also here we have a volume imbalance. We have no actual bodies passing through these candles. That's our volume imbalance. And now, friends, we see here we had buy stops. We had buy stops over here. That were taken out. You have buy side liquidity. That's our buy side liquidity that was taken out. Immediately after it was taken out, price went for our sell side liquidity. We have a bunch of sell stops resting below this all lows. And friends, I think as far as our first video is concerned, I think that's just about it. And until we talk again next time, I wish you all well and stay safe, and thank you.